What's up traders, Tom here with another video. Today we'll be discussing our technical analysis levels for indices such as the S&P 500 and others, Goldman Sachs' recent comments on the economy and where their price target has now changed to, and the idea of negative interest rates around the world. What will the Fed do in the coming weeks? Stay tuned. So before we get started, I'd just like to remind everybody to, of course, subscribe and hit that alert button if you enjoy our videos and want to see more content. And, of course, join our free public Telegram group if you want to get involved in the trading community and have some discussions about your setups and analysis. So no surprises, Goldman Sachs has changed their S&P 500 again in terms of the level they're expecting, and they believe that it will now hit the 2400 level with a year-end target still being at 3000. So according to Goldman Sachs, several factors would contribute to the US stock market crash, which include international tensions, the 2020 US presidential election. We will be discussing this more on the channel coming up in terms of its effects generally on the stock market. Companies lowering their dividends, definitely a thing. Higher provision of US banks and lower share purchases, staggering recovery, and of course increased infections outside of New York. I would say, and add to that, the potential of the second wave. We'll post a video above if anyone hasn't watched our video on that. But look, Goldman Sachs is going to change its targets. It's important, though, that they're changing the rhetoric. So depending on what the Fed says and what the Fed moves forward with, it will change everything. A few other things I want to mention. The New Zealand Reserve Bank have come in today and they've basically said that they will consider negative official cash rates will become an option in the future. And this is so key and important. This has not really been outside of Europe a thing, and of course Japan, a thing for a long time. And we may have never been there if it wasn't for this current crisis. But for them to even consider this opens up the idea that so many other Western nations will now be considering that. And that's why we're seeing optimism ahead of the Fed. And the importance of that is that, of course, the information that is being provided will always lead generally to a technical level being hit before a market has a key announcement. So making sure that you're aware of what's going on from a fundamental standpoint when you're an indices trader is really, really important, or a stock trader. So many of you would be aware that I'm Australian based on my accent and of course the videos that you've been watching. But it's interesting that the current trade tensions that were really between the Eurozone, America, and China are now starting to boil over into our country as well. I noticed Trump ordered the federal retirement money that was invested in Chinese equities to be pulled, and this seems to be a rhetoric that is happening more and more and will take an effect on all markets if it starts to escalate. In Australia, multiple beef and other agricultural commodities have now been banned or semi-banned or threatened upon, and this is going to have a shock effect if it continues to escalate. So it's important to watch that. The second thing is this video is recorded before Jerome Powell has his speech tonight, but it's important to always be aware as a trader of this information, and things like this website here, PIIE.com, has a nice live stream to the event. So always make sure you're aware of the key news that is coming out whenever you're trading anything. And at this time, of course, whenever the Fed is talking, we must listen and watch. So what are our current thoughts on the S&P 500 from a technical standpoint? Now, many of you would have seen the thumbnail and I said it's the bear's last stand, and I really firmly believe it is the bear's last stand. So here we have the S&P 500 and we had a shooting star rejection, which we've discussed on this channel before on the weekly chart. And the importance of this is that generally this is a negative sentiment candle and it came off the 61.8 Fibonacci. So the most important Fibonacci from many people's technical standpoint, we had a shooting star, we had a new low broken, and of course the market was still not able to continue with that due to the Fed, due to the fiscal stimulus, etc. Now the market is moving before the speech, And basically, we're seeing the market coming back up with optimism that the Fed will further support the markets. If they don't, I would expect the bears to come in with full force and to start pushing this market down to try to break the 2800 zone, and then our all-important 2726 will be met. So let's take a look at that level now and talk about it again in terms of what our thought process is. So the idea of the 2720 being so important is because it's the first time that we're going to see a level that has been multiple touched actually broken through. And on top of that, we've got a series of highs, lows, lower highs, and then we will have a lower low here at the 2800, which will definitely signal selling, that then will push very quickly into the 2726. Now, for me as a trader, when I'm trading this, if you only want 60 points, when it breaks this new low, it will gravitate generally to the 2726. So if you're on the smaller time frames and that's what you're looking for, then that definitely is the option. The other option though is to take it after this point is broken, because this is going to be the critical point where you see a lot of traders coming into the market and working on selling their position to pretty much around the 2600. And then of course, Goldman sees that 2400 over here. So Goldman's aiming for 2400. If it hits 2400, it definitely could bounce off. Price action will be the key here. But if I was a bear in this circumstance, I would never be shorting it here. I would always be waiting for the price action to show me that the market is on board for that ride. Basically, if this level is not respected and the market gets through here, it will go something like this, where it will break up above the 3000, come back down, test the 3000, hit resistance at 3100, and then really I think the bears will be relatively exhausted, so it could go all the way to 3200 before finding more problems. And that's why I call it the bears last stand, because it's such an important Fibonacci level. Generally, when this Fibonacci level is broken, sentiment changes completely and we see the continued bullish upside. And what the Fed is putting into the market is a ton of fiscal stimulus. It's so much money. It's really supporting the market. And we're seeing what I would call a massive disconnect between the current markets and, of course, what is happening in the real economy. And that's been happening now for about a month, but the disconnect is getting very real if this level is broken. So many followers would know that I'm actually not a fan of trading the S&P 500 at this point if you're a trader. I'm actually a fan of looking at different indices and using the same idea and the same concept of weakness if you're a bear on the other indices. Now, if I was a bull, I would definitely say the S&P 500 is the best choice because it's the one that's getting the most amount of money pumped into it to save the larger companies. But what I like to do is I like to think about the market as, what am I trying to achieve? And if I'm trying to achieve a profitable trade in a bearish direction, and my idea is that the economy is not doing so well, why would I target the top 500 companies where at least 50 to 300 of those are being heavily supported by the Fed? Why wouldn't I target the weaker companies and see if the price action was showing me something very similar? So this brings me to my point that I've discussed in this channel before, the US 2000 or the Russell 2000. So let's take a look at that now. So here we have the Russell 2000, and I've drawn a trend line across what I think is the key level for breaking of the Russell 2000. There's a couple of reasons for this. One of them is that if we look at the horizontal support that has happened on this particular pair, we have resistance becoming support, and it's literally coming together with the trend line. So this is going to be such a key point in terms of bearish sentiment. If the market comes off, sells down, does a roll reversal, and then breaks to a new low and gets past this point, this is going to trigger a huge amount of selling. And if you're trading the Russell 2000 and you're trading the weaker companies, the smaller companies, the ones more susceptible to this current outbreak and current crisis, then you're going to have a bigger success chance with this market. And I think that's why I think the Russell 2000 makes a lot of sense, and so does some of the other economies such as Germany and the DAX and other indices for you to look at technically. So key levels, 1255 on the Russell 2000. If it breaks below there, we'll be covering this. Again, this index is moving higher. It has moved substantially off its lows. If we think about where it was under 1000, that key kind of support zone. We've got that 960 level being hit, and then it's gone all the way back up and hit 1380. And when it hits this level at 1380, we just have to think about that and think, okay, well, that is a huge increase. It's actually from bottom to top, well over 38% in terms of increase. So we are seeing a massive increase in this market, but also more susceptibility to weakness. So I would argue that the Russell 2000 is the better index to look at in terms of shorts than the S&P 500. So during the recording of this video, Jerome Powell had his speech, and in that speech he mentioned the significant downside risks to the economy, and he also mentioned that the US is in a massive economic downturn in terms of the current state. And this is clear to everybody that is looking at any of the figures. So he basically reiterated those figures and reiterated that he is still concerned about them. He did mention that the Fed would try to perform further acts in the future if needed and when needed, which I think will semi-stabilize the markets. But he didn't say anything new from what I've seen as of this recording. And with the uncertainty and the fact that he basically mentioned that there could be a prolonged recession after the crisis, these things may lead to further bear market action, especially tonight. The first thing I want to do is just have a look at the technicals, and I think I wanted to come into the 1 hour chart and have a look at the 2840 area. So we see that last night this level was tested after hours in the futures contract, and the market has pulled up and sold off a little bit off the speech so far. The importance of this is that it's pulled back with what looks like to be a flag style pattern. And when it comes to flags, the most important thing is that we're looking at probably it being around a 38.2 pullback, and that's what it is. I really love 38.2 pullback Fibonacci's. If the market does continue to break down and breaks past the 28.30, that further exposes, of course, the 27.80 and our key level at 27.26, which we've mentioned several times on the channel. So look to the markets tonight, look to the closes being under the 23.36, and then I think the bears are really making their stand. So more to come on that. As always, if you enjoyed this video, please remember to give it a like, comment down below if you have any questions, and remember to subscribe and hit that alert button for more videos on the financial markets. Happy trading, everybody.